Hi guys, welcome to my channel. In today's video, I am going to talk about the common mistakes that people make as a beginner investor. These mistakes can cost you a lot of time and money. It is best to avoid these mistakes. However, as an investor or trader, you will make one of these mistakes at one point in the stock market. I am not a financial advisor, therefore, please use my information as a guidance or reference. The reason I am making this video is because I have lost some money by making those mistakes when I first started. Therefore, I want to help the people who are new to the stock market and give them a starting boost and tips. This way you guys can make more money by making less mistakes. If you find this video helpful, please like, share, and subscribe if you're new. I thank you all for the support. Alright, let's begin. Mistake number 1, that is following the crowd. In many cases, the majority of people only hear about an investment when it has already performed well. If certain types of stocks double or triple in price, the mainstream media tends to cover that move and tell everyone about how hot the shares have been. Unfortunately, by the time that the media tends to get involved with a story about shares rising, it is usually after the stock has reached its peak. The investment is overvalued by this point, and the media coverage comes late to the game. Regardless, the television, newspaper, internet, and radio coverage push the stocks even higher into excessively overvalued territory. We have seen this trend play out recently with the recreational marijuana stocks and GameStop, for example. Some of these tiny companies had only 2 to 3 employees, but that did not stop them from being valued at a corporate worth of about half of $1 billion. In other instances, an old nearly defunct gold mine would add cannabis or marijuana to the name of the company, and the shares will instantly double or triple in price. At no point were investors looking into the company deep enough to realize all the problems. Tens of millions of dollars in debt, no revenues, millions in ongoing losses each month. Mistake number 2, that is being driven by impatience. When it comes to investing, you may have different emotions, but the one that is most costly is impatience. Remember that stocks are shares in a particular business. Businesses operate much more slowly than most of us would typically like to see, or even than most of us would expect. When management comes up with a new strategy, it may take many months, if not several years, for that new approach to start playing out. Too often, investors will buy shares of the stock and then immediately expect the shares to act in their best interest. This completely ignores the much more realistic timeline under which company operates. In general, stocks will take much longer to make the moves that you're hoping for or anticipating. When people first get involved with the shares of the company, they must not let impatience get the best of them. Mistake number 3, that is using money you cannot afford to risk. You will be blown away if you could see how different your trading style becomes when you're using money which you cannot afford to risk. Your emotions get heightened, your stress level goes through the roof, and you make buy and sell decisions which you otherwise would have never made. An old proverb says that you will eventually lose every dollar with which you gamble. You should never put yourself into the high-pressure situation where you're putting money on the line which you need for other reasons. The first thought is to only invest in speculative shares with risk money. However, we can take it a step further and suggest that you do not even use real money when you are getting started. Consider paper trading, which is no risk and requires no money whatsoever. Then, once you get good at paper trading, you can migrate towards trading real cash. When you invest with money that you can afford to risk, you will make much more relaxed trading decisions. Generally, you will have much more success with your trades, which will not be driven by negative emotions or fear. Mistake number 4, that is doing too little due diligence. To do the proper amount of due diligence, especially with highly speculative and volatile penny stock shares, it takes a significant amount of work. The more due diligence you perform, the better your investing results will become. If you look at every warning sign and every aspect of a company, you're much less likely to be surprised by any individual event which affects the business. When you see the potential risk, and you feel confident in all the aspects of the company into which you've been looking, you're partway to having performed appropriate due diligence. The vast majority of investors do not even come close to doing enough due diligence into the company that they invest in. Most people just want to find a company that seems to make sense and sure increase in value because the underlying industry is up and coming. For example, electric cars will become a bigger deal soon, so people might assume that investing in an electric car stock is a good idea. Unfortunately, to be a good investor takes a lot more than the simplified surface considerations and shallow logic. Mistake number 5 and the final mistake in this video is expecting too much from the stock. This is especially true when dealing with penny stocks. Most people treat low price stocks like lottery tickets and anticipate that they can turn their 500 or 2000 into a small fortune. Of course, this can sometimes be true, but it is not an appropriate mindset to have when you get into investing. You need to be realistic about what you are going to expect from the performance of the shares, even if such numbers are much more boring than the pie-in-the-sky levels for which you may hope. Look at the performance of the stock up until this point. Also, watch all the other investments that are competitors in the same industry. Historically, has the underlying investment gained 5% or 10% per year? Or have those moves been closer to hundreds of percentages? Do most companies in the industry see their shares moving 1% at a time, or is it more common for them to jump by tens of percentages? Based on the previous performance, while not indicative of what may be to come, you could get an idea of the volatility and trading activity of the underlying shares. Typically, a stock will continue to act mainly as it has in the past, and usually that will be in line with the overall industry. Lastly, here's my message to you guys. Ideally, you will not be committing too many of these common errors. However, the fact of the matter is that majority of the investors, in most cases, will continuously fall back to making some of the mistakes which I have discussed previously. Luckily, you can use your losses and mistakes to learn how to avoid them next time. In fact, most people learn more from their losses than they do from the gains. Given enough time and a sufficient number of bad trades, you will be in a much superior situation. Ideally, you will phase out the common mistakes quickly enough that you still have a big part of your portfolio left on the other side. Then, with all these tips that I just mentioned, you should be able to start gathering some profits.